Hello there, John Hardy here with another Video FX update. Today's title, The Storm ? Because last Friday we had the theme of is this the calm before the storm? As we noted the very low level of FX volatility. And we're seeing some few signs, at least technical signs of an interesting reversal in the dollar today. And so that gives us a toehold or a potential trigger for further volatility. That's because we would believe that volatility lies on the side of dollar strength more than a continuation of dollar weakness. Interesting technical situation there. And we did see the dollar reversal of fortune today as we go through today's highlights. Euro dollar posting a new high, cable trying back above 163, Aussie dollar trying the top of the range, etc., etc. These being turned back quite sharply in favor of the dollar. So the dollar bears having to deal with that, at least for in the near future here, to see if they can come over this latest hurdle. Most volatile currency on the day, at least by appearances, was the pound sterling, with this appointment of this new Bank of England NPC, Broadbent, who is considered a hawk, but he's also replacing an existing hawk, sentence on June 1st. He, in his statements, indicating something like believing that a rate hike on the order of one rate hike per quarter is in order, and that is below what the market was pricing in for a forward path for the Bank of England. And this saw the sterling a bit weaker, both against the euro and against the dollar. So with rate differentials being such a big issue here lately, that had a strong effect. As for the bond rating agencies, we can tell that they're having a diminished effect in this market with their announcements. As earlier today, when Eurodollar was trading above 140, the announcement from Moody's that it was downgrading Greece and Greek and Portuguese debt, seeing no reaction. And this followed Friday when Spain, or when Fitch announced that it was putting Spain on negative debt watch, and that's just goes to show that these bond rating agencies are very slow on the sovereign debt moves, not wanting to step on toes, and we can pretty much ignore their announcements, and it seems to be a better exercise to look at the likes of rate spreads, CDS spreads, even news stories about signs of political head bashing and lack of agreement. So, and on that latter account, some interesting lack of agreement, but we'll get to that in a moment. Eurodollar, again, it suffered a temporary defeat at this round number 140 level. That's often the case with Eurodollar, that it finds these big round numbers as interesting areas. So this will be a key zone to watch, the 140, the figure level in Eurodollar. We had some mixed rhetoric from the Fed. I think Fisher out indicating something about QE2. He might be interested in nixing it, whereas Lockhart was out basically contemplating QE3. Now, you have to wonder if there are really any fence sitters in the Fed. We have some pretty dramatically different rhetoric out there, and it's our idea that the Fed will, the dovish majority led by Bernanke, will be happy to print money print the dollar into oblivion, and that it will be up to external forces to stop this Fed from its QE, endless QE. So it's hard for the hawkish faction to get enough attention, to get enough credibility to move the overall Fed expectations. But of course we'll be watching going forward if that mix changes. But for now, the dove's certainly in control. In the markets, one interesting market we noticed today was copper, with the bottom falling out there quite heavily, and this of course would be an Aussie negative factor if that continues. Aussie, very much a commodity currency, so that's one worth watching there. Themes, again, interest rate differentials very much dominating today. A perfect example. Early in the day we had the dollar weaker, but the interest rate differentials had not spread to new lows for the dollar. And I noted this. I said, well, it looks like oil prices are going higher, and this is considered a dollar negative, but the interest rate spreads have not gone there. And sure enough, shortly afterwards, this development reversed. So this is clearly a factor. Also, of course, the reaction to the Bank of England news, very concentrated action in sterling. So it shows that these interest rate differentials are very important for the moment. Of course, as a background thing here, We have the worry that this Libyan situation is here to stay for a while. Clearly, Gaddafi able to rally enough resistance that we can't expect an Egyptian-style revolution to happen in a day or two. So that would be a considerable worry if the longer it drags on, obviously. And I would say still in the background, a very important factor here, and it's in our title, the storm, for today's presentation. The idea that the FX volatility is extremely low, especially relative to what it might ought to be with what's going on in the world, and some of the energy developing in the likes of the equity markets, which is still in a range, but showing some pretty drastic swings day to day that it hasn't shown for a long time. And I think there's a potential here for higher volatility. That's and volatility in general may be underpriced. A specific thing about today being that we did see a technical reversal, so does this set off a new cycle here? Looking ahead, another potential source of market volatility would be the U.S. Treasury auctions this week. These were very interesting the last time around. This set of auctions, it's the 3, 10, and 30-year auction. The last one was 4 weeks ago, and the 10-year auction, actually let's start with the 3-year auction, was very weak. Had a lot of people worried, and that was actually defined the high in yields for the cycle, as yields were headed higher at the time, the highest level in quite some time. And then the 10-year auction came in extremely strong, with very heavy foreign demand. If I recall correctly, it was record foreign demand as a percentage of indirect bidders. So this will be an interesting one again to test the waters. Now we've come back in yields. Is there still that foreign demand? And that's an important parameter for whether the dollar continues to find support here as well. The 30-year likely to find less interest, of course, with that duration. The worry that that you're losing. Of course, the worry over fiat currencies and the idea of Fed printing money, that there are fewer parties out there willing to commit to a 30-year duration. We have a new Irish government forming. It's Fine Gael and the Labour opposition. Let's see what their first big announcements are going to be in the coming days. U.S. data this week, trade balance and retail sales. RBNZ out on Thursday, Wednesday evening for those of us in the U.S., and Bank of England on Thursday. Those are the two key central bank announcements this week. Bigger one going forward, cycle-wise here, especially for the euro, obviously, is the EU summit on March 25th. And we'll keep you posted on the rhetoric as we head into that event. Okay, speaking of volatility, let's have a look at the FX volatility, which is shown here in yellow, and the VIX shown in green. Let's see if we can spot the correlation. That was obviously a humorous attempt at humor. Basically, we've seen a stabilization here. It seems that around 15 is the maximum potential for volatility to fall in the VIX. But on the FX volatility, we've continued to fall through this phase when it appears the equity volatility is picking up. And obviously, I think that situation is unsustainable, especially if equity volatility continues to pick up, that FX volatility continues to fall. So that means danger levels rising for larger moves in spot in the FX market. It also means opportunity for those that are willing to try their hand in long vol trades. But this is a very interesting area to watch, and it is what will tell us that the potential for further volatility going forward, with possibly equities being a leading indicator here, since it seems that FX is dragging its heels at the moment. Going to our charts, let's start with Eurodollar. Here's that trend line. It's been fiddling around with it on the weekly. The price also now at this, it's almost hard to see because of all the coinciding lines here, but this black line is the 200-week moving average, which is around where we're trading. We head to the daily. We see the small attempt above 140 on the day, rejected. But look how steep the ascent has been. So we can easily consolidate around back to the old high 138.50 or so without reversing the overall trend. Just short term here, suggesting a little bit of a barrier to further upside. Cable, on the other hand, a more profound development here with this very emphatic rejection of the test of the high of the range, a very bearish candlestick, and it leads you to believe that we could be headed back towards a 160 test going forward. But in general, it's been a very sort of ugly, slowly rising channel there from 160 to 163 over the last, let's call it a month and a half almost on cable. Euro sterling, with sterling headed so weak against the dollar, obviously going back towards the highs of the range. And we have these highs here. There may be some potential more on all this interest rate hysteria, but it seems hard to believe, it's hard to believe that the euro is going to ascend into the clouds based on interest rate views. Yes, it's been a driver. It could drive another little ways here, as the belief in the ECB hiking even more could extend a bit further. But the idea of euro strength on a massively hawkish central bank relative to the rest of the world seems a bit of a stretch to us in the longer term view. Euro Swiss, no real interesting development of lately there. Euro yen as well. We saw the rejection on Friday, but that hasn't been a huge follow through lower. And dollar yen finding a little support as the bond rally tail off today ahead of those key auctions. And of course, with U.S. Treasury auctions, we got to think this is critical for dollar yen. In fact, if we look at the actual days here of the last auctions, let's put this on cursor information, and we can see this day here. Sorry. The last Treasury auctions occurred here. In fact, not making much sense in terms of the direction that rates took, because rates headed lower, which would normally be dollar yen bearish. But so that's actually very interesting that we're not seeing as much a confirmation. This, however, did coincide with the front end of the curve heading off. So in a general, any strong move in interest rates would be expected to affect the yen crosses the most. A lot of confusion there. Again, the Ichimoku level is very interesting. That was where it defined the high today on dollar yen. Moving along here, let's have a look at dollar Canada. We have an old rule of thumb saying if we don't follow through after 4 days, that you're in danger of a reversal. We've had about 4 days here. The ranges have been low. Let's see what happens. Aussie dollar, this formation pretty dramatic, 102 being the top line, except for this thing where we've argued that above 102, because it happened on the 31st, that it may be less interesting of a development. In any case, this ascending triangle, one of the ideas that I've been intrigued about in the past is the idea that the longer a formation holds, actually the less powerful it is, because sometimes it means that the intended direction just doesn't have what it takes to get there. In other words, that this is supposedly a bullish formation, but it's been going on and biding its time for so long that it suggests that the bulls may not be there to push this thing higher. For that to be correct, we need to see equities come off, we need to see copper to continue to sell off, and we need to see rate expectations coming off as well. Certainly, the status quo would be that this is a bit too expensive even now, at least relative to perhaps parity or 99, not by a huge amount, because of the fact that interest rate spreads have simply gone nowhere during this whole phase of the recent market action. Kiwi suffering, but we're heading into an RBNZ. Dollars are, etc. Oil trying a new high relative to this post-spike environment and getting rejected. Note the similarity of this development with other markets, getting a lot of cross-market correlation. That also suggests a higher volatility risk, if you ask me. And again, with the S&P 500, seeing a big area of pretty large moves. We're starting to break down below this trend line that goes way back. And the day-to-day sort of rapid back and forth here is what suggests the energy level in the equity markets, to me, is increasing. So let's keep an eye on that as well. Interesting to see crude coming off pretty sharply from the lows, and to see some risk aversion in equity markets. This being 50 minutes before the U.S. close, though, with the HFT environment, I could have egg in my face by the end of the day, and we could reverse the entire thing. We have some of these amazing late day moves in U.S. equities, so keep an eye out for that as well, obviously. Let's see, what else did I want to show? Yes, the Euribor, March Euribor, barely budged today, and the proof here in why euro sterling is higher being, of course, that the March short sterling rallied quite strongly after the broad-bent comments. Copper coming off, and this is finally copper sort of locally did not reach a new high recently. It's actually quite been sort of rallied a bit, but is off quite a bit today especially. But finally seeing some negative action, quite negative action in a BHP Billiton. And this is a equity we have seen a very tight correlation with Aussie dollar over the months, recent months, and even years, if you will. So what all do we have today? Well, we've seen a dollar reversal. It hasn't been horrifically high volume or high volatility reversal, but it's interesting. We'll keep our ears to the ground and see what's going on in the days forward. I think looking across markets, the risk is that volatility continues to pick up here after we've seen an amazing amount of complacency recently. With that in mind, stay careful out there, and we'll be back tomorrow with another edition of the Video FX Update.